Today we're covering 32 finance and investing terms that every investor ought to know. Basically, this is financial jargon for beginners. In the next few minutes, you'll get up to speed on the financial terms you need to know to have a basic understanding of the world of finance. My name is Dieter Scherer. I'm a certified financial planner and founder of RealizeYourRetirement.com, and I'll be walking you through these terms today. As I'm a financial professional, I need to post some disclaimers. Please read through these before we continue. First up, stocks. Stocks are pretty straightforward. Each share of stock is equal to a small piece of the overall ownership of a company. If there are 4 shares of stock in a company and you own 1 share of stock, you own 1/4 or 25% of the company. The numbers change as companies get larger, but the basics stay the same. To watch another video where I take a deeper dive into the basics of stocks, just click the word stocks and it will take you there. Market cap is the value of the company on the open markets. It can be calculated by multiplying the price of 1 share of stock by the number of shares of stock outstanding for that company. It's the value you would pay if you bought all of the shares a company has issued so far. Here we have 2 investment styles. Growth stocks are stocks that are expected to grow fast in the future to justify their high prices relative to their cash flows. Think Amazon or Netflix. And then we have value, and value companies are stocks that are on sale versus what their true worth really should be. The trick is that when you're valuing the company, that your value of the company is the right one, and that the market eventually realizes the stock is mispriced and bids up the share price to what it really should be. Warren Buffett is an example of a famous value investor. There are 3 sizes of companies you'll hear about most often. Small cap stocks are stocks of small companies that have a market cap of less than $2 billion. Mid cap stocks are stocks of medium-sized companies that have a market cap between $2 billion and $10 billion. And large cap stocks are stocks of companies that have a market cap greater than $10 billion. Bonds in their simplest form are a loan that you make to a company or government, and they pay you interest on that loan and eventually repay the original purchase price of that loan. To watch another video where I take a deeper dive into the basics of bonds, just click the word bonds and it will take you there. Interest rates are simply the price a borrower pays each period, usually a year, to borrow a sum of money. A very basic example would be a loan of $100. If it has an annual payment of $5, it has an interest rate of 5%. You pay the $5 each year as the cost of borrowing, on top of the payments you make to repay the loan. Bonds have a certain date at which they mature, at which point you repay the original loan you made to the borrower. Whereas default is when a borrower, typically a borrower for bonds is a government or corporation, when they don't make their scheduled interest payments. There are a few types of bonds, and treasuries are government bonds issued from the U.S. Treasury. Corporate bonds are bonds issued by corporations. Agency bonds are issued by government agencies like Fannie Mae and Freddie Mac. Municipal bonds, or muni bonds, are issued by local governments and municipalities. And mortgage-backed securities are groups of home mortgages that are packaged so that they pay you like a bond. Now, there are 2 major grades of bonds. Investment-grade bonds are the least risky type of bonds. These bonds have a BBB rating or above. Investment-grade bonds are issued by stable governments and established corporations, whereas junk bonds, or high-yield bonds as they're called, are bonds with ratings below BBB. These carry a higher chance of default, but this higher risk causes them to pay higher interest rates. Alternative investments can be pretty complex, but at the heart of it, alternative investments include anything that isn't a traditional stock or bond investment. Some examples would be real estate, commodities, currencies, options, derivatives, and then more esoteric strategies like long-short strategies. Let's just define some of the alternatives you're likely to hear about. Real estate is easy to understand. You can invest in buildings and land either directly or more commonly through real estate investment trusts or REITs. Commodities are raw materials used in manufacturing or consumables that consumers buy and use. Some examples would be oil, natural gas, cotton, coffee, and copper. Derivatives are anything that does not have a value on its own, but instead derives its value from another investment. Basically, it is an agreement that pays off if certain circumstances are met. Options, futures, and credit default swaps are all types of derivatives. A mutual fund is an investment structure that allows you to pool your money with other investors so that you can achieve economies of scale while investing. Together, you hire investment managers to manage the group's money. All orders to buy and sell are processed at the end of the day, so no matter when you purchase it during trading hours, your order goes in at the end of the day. And typically, all capital gains and dividends are passed along to the investor, making this a less tax-efficient way to invest in taxable accounts. Whereas ETFs, or exchange-traded funds, have become a very popular way to invest for good reason. Think of these like mutual funds version 2.0. All right, just like in a mutual fund, in an ETF, you pool your investments with other investors and you hire a manager to manage them. But ETFs are way more liquid and more tax efficient due to the way that they redeem and create the shares of ETFs. So instead of just being purchased or traded at the end of the day, ETFs are instead traded like stocks. You can buy and sell them at any time of the day. And because of the better redemption creation process by which ETF sponsors bundle the underlying investments, not all dividends and capital gains need to be distributed to investors, which makes them more tax efficient. And to put some icing on the cake, ETFs typically have much lower fees and trading costs than their mutual fund brethren. ETNs, or exchange-traded notes, sound a lot like ETFs, but there's one crucial difference. With an ETN, you are buying a contract from an issuing bank that promises to pay you the returns on an asset class or strategy underlying the ETN. So instead of your money being directly invested in the investments that the ETN is tracking, you give your money to the issuing bank and they can either invest that money directly or use options and other derivatives to track the strategy of the ETN. There are some tax benefits to ETNs because most, if not all, of the gains you make from an ETN are treated as capital gains rather than ordinary income. But you have to keep in mind that if the bank becomes insolvent, you may not get your money back because during a bankruptcy, these act like bonds that aren't secured by any collateral. Just like ETFs and stocks, these can be traded throughout the day, rather than only at the end of the day like mutual funds. And finally, these have a maturity date like a bond, at which point the ETN winds down and disperses all the funds to investors. You might ask why I included cash here, but cash goes beyond just straight dollars sitting in your account. Cash includes anything that is liquid and can be converted to cold hard cash within 90 days or less. That would include things like cash, 90-day treasury bills, and money market accounts. All of those would fall under this category. Annuities are an insurance contract between you and an insurance company that promises to pay you a certain income over a period of time. Annuities nowadays are a lot more complicated than they used to be, so I offer both annuity reviews of popular annuities and an annuity myth ebook on my blog, realizeyourretirement.com. The Federal Reserve is the central bank of the United States. It is typically called the Fed. The Fed influences interest rates through treasury purchases, like the quantitative easing programs you've heard so much about over the years. It also sets reserve requirements and the discount rate for loans to banks. And finally, it determines the supply of money in the economy, as well as conducting many other regulatory oversight duties for the banking industry. Asset allocation is the process of diversifying your portfolio's holdings across several types of asset classes. This is one of the more important steps of portfolio construction. For example, your portfolio may be allocated across global stocks and global bonds, say 60% to global stocks and 40% to global bonds, to use the classic 60-40 portfolio. Inflation is the increase in prices that typically occurs each year in a healthy economy. For example, if bread was $1 last year, it increased in price to $1.02 this year. Inflation was 2% over the last year. Rates of return can be differentiated by whether or not they take inflation into account. The nominal rate of return is the return on an asset before the effects of inflation are taken into account, whereas the real rate of return is the return of an asset after you adjust for the effects of inflation. To get the exact number, there is a different formula, but real rates of return can be approximated by simply subtracting inflation from the nominal rate of return. So a 10% nominal return minus 2% inflation equals an 8% real return. Thanks for watching. You should now have a basic understanding of a lot of the financial jargon that gets thrown around by financial professionals. Click the link in the middle to subscribe to my free video course, How to Protect and Even Grow Your Portfolio in Any Type of Market. You'll learn the 6 biggest myths of Wall Street, why most experts fail to beat simple rules in finance, and how to use risk management tools to guard against recessions and market crises. If you'd like to learn more about how to properly diversify your portfolio, an important concept in investing, click the top video on the right. If you'd like to learn more about how investment risk is measured and what all of those different risk terms actually mean, click the bottom video on the right. Thanks for watching, and I'll see you in the next video.